Hi, and welcome to the Macro Show. We talk macro and try to make sense of. Now look, if the show starts with the crown on, you know the market's made sense today. Why? Because simple. Stocks were down, treasury yields were down, bond prices were up. What makes more sense than that? I'm your host, Steve Van Meter. Thanks for joining me today, because today's show is all about retail buying in at the top. They always do. But we're going to talk about the dollar bulls. We've got the emergency lending programs that were suspended by Steve Mnuchin. Why did he do it? Why did he take the Fed's toys away? Poor sorcerer JP. China's got some debt defaults going on. I got a slew of charts for you. Did I mention the dollar? Yeah, we got to talk about the dollar, because a number of you have said, Steve, what's going on with the dollars? Why isn't it going up? Others say, Steve, you're a complete idiot. I told you the dollar's going to keep going down, even though it hasn't. I'm going to show you some pretty conclusive evidence on what's going to happen with the dollar. Plus, we've got the H.8 data and all kinds of other good stuff, I'm sure. And of course, we have to look at the charts of bonds today. I mean, this isn't a given that we have to look at that, because, as I mentioned, the siege was over. I called it over a couple days ago or so. I just had a feeling. And what's happening now, we're dragging all the corpses of the speculators and the bond shorts, and we're pulling them back from the battlefield, away from the castle walls. Now, will some of them, get up and try to make a feeble attempt at the kingdom again? Sure. But you can see we're having no trouble pushing them back. That's how you know a siege is over. All right, let's start with the key thing going on, and that is, what's up with Steve Mnuchin and sorcerer JP? Well, the Fed went to, or requested, an extension of all of their emergency lending tools that were granted to them during the March liquidity crisis. And Steve Mnuchin, who mentions that he was an architect of many of those programs, said that's not going to happen anymore, and we're going to get rid of a bunch of these acronyms because, well, that's what they are, on December 31st. Mainly, he's saying, look, I want some $455 billion back that we gave you. That's what we want back. And we're going to let you keep some of your other toys, but they're going to expire in 90 days. Now this is absolutely bond bullish, even though it is not overly relevant. Now, if you may remember back when these tools were put into place, I didn't actually want to talk about them. And many of you said, no, Steve, we got to talk about. Okay, so we did. And I said then, as I'll say now, they are largely irrelevant. They did nothing. But the view, the belief that the market had is, oh, they're inflationary. All right, well, if they're going away, then they're certainly not inflationary. They're perhaps disinflationary or deflationary. And how did the bond market react today? Well, it reacted just as you might think. Bond prices were up, treasury yields were down. As I mentioned, and no, I'm not going to get tired of putting this arrow up today, not at all. And so the market interpreted it just as we would expect, because the opposite reaction happened before. Now, is this really a big deal? Well, one of the issues here is these tools weren't widely used by the Fed. I mean, they were given quite a bit of money. They didn't use most of it. So it doesn't make any sense for, sorcerer JP to keep having his toys. After all, perhaps Congress could reuse this money somewhere else. And we're seeing in the Treasury auctions, and you kind of notice that, a number of them lately have been below their 6-month average of bids, and some of the dealer takes have been higher this month than normal. Of course, also the auction, some of you say, well, yeah, but they're auctioning more money, right? And what the global community is telling the U.S. Treasury is, hey, look, you're starting to borrow too much money here, and you need to get that under control. Now, will this lead to less borrowing? I don't know. It might. But you can also get some perspective of why, is Mitch McConnell and the Senate, kind of pushing back on these big stimulus. They're looking and listening to what our foreign investors who buy most of our Treasury securities are selling us. And they're saying, look, you're borrowing too much. It's either that or you need to get the Fed involved and get sorcerer JP to cast some more QE spells and buy up more of that debt. And what did we hear from JP recently? That's not going to happen. I'm not going to work in conjunction with Congress to monetize all this debt. I'm only going to do what I need to do to maintain a smooth functioning market, or loosely translated as, hey, as long as stocks are up, we're good at the current level. If they go down, then yes, I will do some more. So he's not going to change that. So effectively, Mnuchin took away some of his toys. Is it really a big deal? Yeah, not so much. Now, we have seen some China companies starting to default on their debt. Now, this is not something you actually expect, and I didn't have time to pull up an article for you to look at. This isn't something you expect in a state-owned economy where the government owns a lot of the businesses. You wouldn't expect them to default. This isn't a dollar shortage issue, my friends. I know some of you think, well, is it a dollar shortage? No. It's a yuan or renminbi shortage. It's a shortage of local currency. Now remember, insolvency events can start anywhere around the world. And sometimes they start small and it seems like, oh, it's just China, it's no big deal. And then next thing you know, major U.S. investment bank is failing that we didn't see coming, called Lehman Brothers back during the great financial crisis. Literally nobody saw that coming. So keep that in mind, that insolvency events build due to currency shortages, which we'll get into the dollar here pretty soon, because that's real key. As long as the dollar stays relatively weak on the lower end of its 5-year trading band, we seem to not have a dollar shortage problem, or the weakness of the dollar is kind of taking care of that problem. Should the dollar rally, and as I expect at some point to break out over 103 on the trade weighted dollar, there's going to be a massive dollar shortage. That I assure you. All right, let's get into the H.8. The reason we're all here today at 1:15 Pacific. We got the H.8. And what did we learn? Bank credit expanded by a whopping $1 billion. Now, this is going to surprise some people. Securities and bank credit fell $4 billion, with mortgage-backed securities falling $4 billion, U.S. Treasuries falling $2 billion, and other securities rising a little bit. You're like, well, wait a minute. What gives? Well, what I want you to see here is the commercial banks are trying to balance the contraction or expansion in credit with Treasury and agency securities. That's what they're trying to do. So let's look at what is going on down a little bit lower in the chart. And that is all loans and leases, wherever that is, rose by $4 billion. So you notice so one went up $4 billion, the other went down $4 billion, and we had a net $1 billion change in securities and bank credit. So all you're seeing is banks are just kind of managing the difference there. They're trying to keep bank credit pretty growing, but they're managing their securities based on their expansion of their loan book. So how about commercial industrial loans? Well, they're down $8 billion. Residential real estate, big jump at $8 billion this week. Commercial real estate loans flat. Consumer loans up $600 million. So not a big change there. Credit cards effectively, all of it in credit cards, $600 million. Not a big change. So where's the other difference? Cash assets at banks took a huge drop. I don't know what the deal is with that, but they're way down. So that's what's going on in bank credit. Now let's take a look at the PowerPoint charts. And we'll talk about the M2. And from here, we'll get into the dollar, and then we'll come back to the chart. So the M2, 12-month rate of change is rising again, 25.28%. It's kind of been steadily rising. The 6-month rate of change is up 6.47%. The 3-month rate of change is at 3.39% and rising. And let's go over to the charts of the M2. And you can see that where are we seeing that increase? Well, we're seeing an increase in savings deposits. We're seeing an increase in demand deposits. And we're seeing a decrease in institutional money funds. Now, several people believe that the M2 has got all this money that's waiting to be spent. Have you ever looked at this historical chart of this? If all this money is being waiting to be spent into the economy or on stocks, it's been waiting a long time, because you notice the money supply pretty much always grows. It's very, very rare, and I don't even know if it'll show up on this chart here. I think you have to go back even further, and you do. It pretty much never contracts on a year-over-year basis. So the money supply is always growing. It's just the fact that it had that burst here due to all the lending and the fiscal transfers from the pandemic, the people believe that this money is coming out. Maybe it's not. Keep that in mind. Maybe it's not. Now let's take a look at the institutional money funds. And here we've got that charted in billions of dollars on the left. This is, again, just this piece down here where it says institutional money funds. And I've charted the dollar in red. And you'll look at the last recession. So when money is going into institutional money funds, what is it doing? It's looking for T-bills. It's demand for dollars, right? And so when it comes out, or when it goes in, you see there's a demand for dollars. When it dipped, which they're not lined up right, but you see the dollar was lagging that a little bit. I'll move the mouse out of the way. The dollar went back, and then as demand into institutional money funds came back, so too did the dollar rise. Here we see a much better picture of that, where the institutional money funds shot up as people went fleeing out of the market and looking for safety in cash or T-bills. And what happened to the dollar? It went up. Now everyone's like, oh, the dollar is going to go down, 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 and down. Well, that is going to require institutional money funds to keep going down. Now, at some point, this will stop going down in reverse, because what just happened over the last 2 weeks, we had the largest flow back into U.S. equities in a 2-week period in the history of the markets. The last 2 weeks. And you're like, well, wait a minute, the market didn't really go up that much. I know. Isn't that interesting? Who's buying at the top? Retail. Now remember, everyone's like, oh, there's going to be a blow off top where all this surge of money's flowing in. Well, there you just had a 2-week surge, record surge flow of money, no blow off top. Kind of interesting. So what will at some point here happen is the money will stop flowing out of institutional money funds. And when the market starts to reverse, it will shoot back up as people flee to safety, and that will drive the dollar up even higher. All right, back to the PowerPoints. Let's see what's going on. With real estate loan growth, it's up to 2.23%, which is a terribly low number despite record low interest rates, as you can see here. 6-month rate of change is up slightly to minus 0.14, and the 3-month rate of change is up slightly to minus 0.42. You should not consider this a massive trend change. It's just there was that little bump of that $8 billion in residential mortgage growth. Also keep in mind, when do people make most of their payments? At the beginning and the end of months, not toward the middle. So let's take a look at commercial industrial loan growth. Is down to 12.49% from a year ago. The 6-month rate of change is still falling to 12.67. 3-month rate of change picked up slightly to minus 5.9. This is not something you see during major bull markets. This is something you see during recessions. How about loans and leases and bank credit at all commercial banks? Growth rate is up to 4.3%. So a slight tick higher, again, due to the real estate is a big component in this. And the 6-month rate of change is at minus 3.86. The 3-month rate of change is at minus 1.57, all rising over last week, mainly due to the growth in residential real estate. How about consumer loans? Credit card growth rate is still unchanged for the 3rd week in the row, flat at minus 10.5%. No demand here from the consumer. Despite the big retail sales number, you can see the consumer credit is not growing. Consumers are not feeling confident enough about the economy to charge up their credit cards. All right, let's go back to the charts and take a look at a few things I've got for you here. One is the import price index versus the consumer price index. So we see import prices improved to minus 1.04%, whereas I did say this would happen. The CPI would start to roll over, as we talked about before, due to the money multiplier. And we can only assume going forward that import prices are more likely to roll over and head lower than they are to continue rising. If they were to continue to rise, then it would likely the CPI is going to go up. But of course, the CPI is going to head lower, mainly again due to the deflationary effects of quantitative easing. Now, some people have asked, what's going on with gold? Why is gold going down? Doesn't make any sense. Well, one of the reasons is real yields, and this is inflation-sensitive or inflation-adjusted yield. So you take the 10-year Treasury, subtract consumer price index on a year-over-year basis, and you get real yield. And there you see real yields are starting to rise. And that's a problem for gold. And I said this would happen if this consumer price index rolls over and starts to head lower. So many people shook their heads, waved their fingers at me, told me I was an idiot, and said, that's not going to happen. CPI can only go up from here. Okay. Well, on a year-over-year basis, it went down. But nevertheless, let's overlay gold here on the right side of the chart. And, well, that didn't work out right, did it? Let's see. There it goes. Okay, just needed to update. And let's full size the chart. And you can see when real yields look like they're going to rise. There's notably, not always, but there is generally an inverse relationship between the price of gold and real yield. So in order for real yields to rise, what do we need to see? The consumer price index start to drop even more, go from 1.2 into negative territory like it did during the great financial crisis, and cause a massive wrecking ball for gold. Now, what could do that? Real simple. The dollar could rally again, just like it did here. And what would it take to do that? People fleeing out of the stock market. Now, why would they do that? Well, one reason is stocks are massively overvalued and everyone's all in. And this is a chart of the percentage of the S&P 500 stocks over. I thought I had the 200-day moving average on here. I meant to have the 200-day. Well, let's fix that real quick, shall we? See if this updates. There we go. And we'll click on the chart. So percentage of stocks over the 200-day moving average. And you'll notice that when it is over one standard deviation, or approximately 74.46%, it marks major inflection points where stocks tend to go down. You can see going back over the last 5 years, stocks tend to go down. When you get into more illiquid periods of the market, it tends to bring them way down. Notably, here is March and cause a sell-off. And here we are looking at this. We're sitting at 84.75%, highest level in the last 5 years. So there are more stocks now over the 200-day more moving average than there have been in the last 5 years. Again, this signals an inflection point that usually there is a reversal coming. And how coincidental is that? That investors, retail investors, are back piling into stocks, record 2-week flow back in. Some things should not surprise you. Now, obviously, if there's a big sell-off in the equities, that would obviously be bullish for bonds. So we got to love that. All right, let's take a look at a couple of charts, and we'll, of course, go through this in more detail on the Sunday chart show. But the S&P 500 over a 2-week record flow. So 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Record flow right here. The stock prices are not making new highs, reversed yesterday's gain, and pretty much down for the week, almost going nowhere over the last 2 weeks. One thing I thought was interesting was even in after hours trading, it looked like the computer algorithms needed to get some stuff sold that for some reason they couldn't get sold during the day. Don't know what the deal is with that. NASDAQ pretty much going nowhere last couple of weeks. Dow going nowhere last couple of weeks. Russell 2000, remember this is moving up on stimulus, which doesn't appear it's going to happen, at least not till sometime early next year, and may be lower than most people think. How about Treasury yields? Remember, so many people said, Steve, here it is, breaking trend lines, breaking down trend lines, breaking this technical thing. Yields are going up to 2+%. I got all kinds of messages and stuff. People were telling me, you're totally wrong about this. And yet, today, they closed below their 50-day moving average. Now, keep in mind, trends start with a cross over the 50-day moving average and a reconfirmation. Well, now you just got to cross to the downside. That means next week, those who are bearish on or bullish on Treasury yields going up need to get really to selling and get this thing turned around, because this is not a trend that is your friend. And in fact, from a technical basis, it looks like we're forming a topping pattern here, and that would lead to lower yields for those of you who want to look at it that perspective. Let's take a look at gold mining stocks, as I've been bearish on those in the short term. Bounce off their 200-day moving average, looking like they could head even lower. Not something that gold bugs want to hear at all, but let's take a look at the TLT, because this is the largest traded long short-term U.S. Treasury bond ETF available, and sure enough, it moved through its 50-day moving average and did not do it on strong volume. In fact, all this move up here has not been on high volume, and this is a good thing, because what does it mean when prices are moving and volume isn't real high? It means we're not seeing a big short squeeze. So short squeezes are when you have a bunch of people getting out, a lot of shares trading hands. We're not seeing that. So a lot of these speculators, when we'll look at this Monday, when we look at how the hedge funds are positioned, if you think I am crazy, well, I know you do, but if you think I am overly committed to the long bond thing, they're overly committed to the short bond thing. And the only difference is I'm right. The data is in my favor. It's not in theirs. But nevertheless, anytime you see price moving up on relatively low volume, that's a good sign. And we're crossed back over. Remember, this is a 50-yard line. We crossed back over it. Clearly a turnover at the 25 as the Treasury bulls take back and are looking like they're going to be in the lead. There's quite a bit of resistance right in here for the technicals. People here, if you're a technical chartist or trader, a lot of sellers right in here and up in here around this 165 level. When this thing gets up past this 166, it's going to flush out a lot of weak hands and cause a big short squeeze. So this is a great sign here. How about the dollar? Despite all of that money flowing out of institutional money funds back into equities, the dollar cannot get below 92. It tells you someone's buying them and they want dollars. And if someone wants them, that means the next direction, because we know that the dollar will follow. Bond price is higher. So this is a great lead going on here. So with that, of course, I always appreciate it when you like, and many of you do, and when you subscribe, many of you have, and I can't get my little sticks there out of the way. And I will see you on Monday, where we'll look at the hedge fund positioning. Thanks to a friend of the show, Brent Johnson, got a preview of that. It's great news. Again, Crown on, whole show, and nothing bad ever happens when the Crown is on. That's the rule of the kingdom, as we declare this siege is over. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It shows not to be construed as recommendation or solicitation by a security, financial instrument, or participating in particular trading strategies. This video was prepared by Steven Van Personal capacity. Business expressive video that do not reflect the value of financial value, Inc. or Steven Van Meter Financial.